Well, hello, everyone. We want to welcome everyone to Brady Ware's webinar covering the impact of the One Big Beautiful Bill Act on business owners. I'm Anita Anand, managing shareholder of Brady Ware, and really appreciate everyone tuning in today. In scanning the attendee list, it was really good to see a lot of familiar names. So we'd like to thank our clients for tuning in today. Also good to see a lot of unfamiliar names. So for those of you that aren't as familiar with Brady Ware, our focus for over 70 years has been to provide business owners and individuals with tax, accounting, and advisory guidance and support. From our 4 offices and more than 150 professionals, we assist with the traditional tax and accounting questions and issues that come up from time to time. But also as advisors to our clients, many times we find ourselves, helping out with some of the more intangible issues that can sometimes be more challenging to contend with. And in some ways, this is one of those times. So, signed into law just about a month ago, the One Big Beautiful Bill Act extended some of, the various tax provisions from what we had before, but also updated and created a lot of new ones. So, what does this mean for business owners? How is it going to impact their businesses? What aspects of their financial operations are now more pressing and require more attention than maybe some others? To answer these questions and a whole lot more, joining me here today to walk us through the new legislation are 3 members of our national tax team, and I want to thank the 3 of them for being here today. Adam Titus, who you'll be hearing from first, will be covering the federal updates. And then we'll go to Jake Gentile, who's going to be covering the research and development, the 174 issues, answering some of those questions there. And then we'll go to Kristen Kraybacher, since many of us here are also individuals as well, right? And we've got individual issues and tax questions as well. And Kristen will be highlighting some of the more notable and noteworthy individual tax provisions as part of the new bill. So let's go ahead and get started. Adam, I'm going to go ahead and ask you to kick us off covering the federal updates.
Thank you, Anita, for that introduction. As Anita outlined, kind of the flow of our presentation today. We'll also have a session for Q&A at the end. So as Bruce mentioned, you can enter those questions as you think of them throughout the presentation. We'll cover those at the end. But there's really, so we think about how this came through. We've got several important dates, and this kind of came together fairly quickly after some negotiations and movement amongst versions of the bill. July 1st, this bill passed the Senate 5150, so fairly split vote there. And then also July 3rd, passed the House 218 to 214, so also fairly split down party lines. And then on July 4th, the president signed the bill into law. So we got a great gift there on a holiday of July 4th of a new tax bill to read and interpret. So if we think about really what are the key provisions in the bill that impact businesses the most, there's really 3 of them. Section 174, which is regarding research and development experimentation expenses. Jake's going to cover that here in a minute. Also, Section 163J, which involves interest capitalization, and the impact overall, some international impact there. And then also bonus depreciation with some changes to 100% utilization and amongst other things. So with that, I'm going to kick it over to Jake to cover Section 174.
Thanks, Adam. So my name is Jake Gentile. I'm a senior tax manager in the Dayton office. I primarily focus on business and individual tax compliance, planning, and consulting, but I also specialize in R&D tax credits. So, which brings me here today to discuss Section 174 R&E capitalization. So what is Section 174? Section 174 governs the tax treatment of research and experimental expenditures. So fairly related to the R&D tax credit, where there is a credit provided if you invest in R&D credit activities, but Section 174 actually governs the tax treatment of these activities. So it includes costs associated with developing new or improved products, processes, or software. It applies broadly to tech, manufacturing, software, life sciences, and more. It does not include capital expenditures such as like property, plant, equipment, or land. But again, it is a key driver of how R&D investments are reflected on your tax return. So as we get into this, I'm just going to go over a brief history of the Section 174 rules, how we got to the fix and the one big beautiful bill. It's important to understand how we got here. That way you can go over, hey, what does this new law do? What options do you have? So let's just start with the pre-Tax Cuts and Jobs Act, the first Trump tax bill. Before 2022, businesses could deduct R&E expenses in the year they were incurred. Alternatively, companies could elect to amortize over a 5-year period both domestic and international expenses. There was no requirement to capitalize or differentiate domestic from foreign research, which will be important later on in this presentation. But this flexibility supported early stage innovation and it helped manage cash flow effectively. So what did the TCJA do? It really affected tax years 2022 through 2024, but the TCJA an amended Section 174 to require capitalization of all research and experimentation costs incurred in tax years beginning after December 31st, 2021. So the law changed the treatment of domestic and international expenses. So for domestic expenditures, it required that these expenses be capitalized and amortized over a 5-year period. For the international R&E expenditures, it required that these costs to be capitalized and amortized over a 15-year period. Depending on the scoring method used, this amendment was intended to generate between 15 and 150 billion in additional revenue over a 10-year period. So, what does that really mean? This law was put into the bill in the first Tax Cuts and Jobs Act to help pay for the tax cuts that were initially provided in the first year and the immediate of the passing of the bill. So you can see the bill was passed back in 2017. This impact didn't occur until 2022. Some of that time gap was, I don't think lawmakers ever really intended that this law would go into effect. So there was multiple bills written to, restore the immediate deduction of these expenses, and they just never went anywhere in Congress. Something would get attached to it or they couldn't agree to it. So we actually ended up in 2022 with the requirement to capitalize and amortize these expenses, which leads us now to the one big beautiful bill. But before we get there, I do want to go over some of the simple math. How does this really affect taxpayers from a tax liability standpoint? So I have two graphics here. The first one on the left is with first year expensing, pre-TCJA. So this is just a hypothetical company, assuming net income before any R&D expenses, it's 2.5 million for this company. The company incurred 1 million of Section 174 expenses, which resulted in a taxable income of 1.5 million because these Section 174 expenses were deductible. We're just, in this example, using a corporate tax rate of 21%. This taxpayer would have a tax liability of 315,000. So let's go over to the right here and just show what the required amortization did to this taxpayer's liability, assuming the same numbers. So net income, still 2.5 million, and the taxpayer still had 1 million and 174 expenses, but they were required to be capitalized. So assuming these were all domestic expenses, the taxpayer was allowed a deduction of $100,000. It's spread over 5 years. And then there's another goofy component where you could only take 1/2 of the first year's amount. So really that amounted to 10% of the total cost. In this instance, it was a $100,000 deduction. The taxable income now is 2.4 million, and the tax still at 21% is 504,000. So you can see what that did to taxpayers. And if you're looking at a software company that's a startup and they're accustomed on the front end to having large losses that is mainly driven by R&D activities, we've seen situations because of this bill, or the TCJA really, that would flip this taxpayer from a traditional taxable loss to now they're in a taxable position. They have taxable income. So you can really see what this law did to taxpayers. So now let's get into the One Big Beautiful Bill Act, what it did to fix some of the R&E expenditure rules that were in place from the TCJA. So what the law did, it added Section 174A, which allows taxpayers to fully expense domestic R&E expenses paid in tax years beginning after December 31st, 2024. A key point to note here is that foreign research expenditures remain subject to that 15-year capitalization and amortization. But there are transition options for those previously capitalized 174 domestic R&E expenses. So if you're a taxpayer that had these costs incurred from tax year 2022 through 2024, you can deduct that remaining unamortized balance in full in tax year 2025. You could also amortize the unamortized amount over a 2-year period, meaning you could deduct 50% of that unamortized balance in 2025 and 50% of that cost in 2026. My favorite part of the bill is that there is a retroactive election for eligible small businesses. What does that mean? It's a business that had less than 31 million of average prior 3-year gross receipts based on the first tax year beginning after December 31st, 2024. So if your average gross receipts were under 31 million, you may have the option to go back and amend tax years 2022, 2023, and 2024. So some of 2024 returns are still technically on extension because it's either been extended to September 15th or October 15th. So a key point to note here is if you would like to go back and amend, you actually have to start with the first year that you incurred Section 174 expenses. So it's really an all or nothing approach. If you would like to deduct those expenses on a timely filed 2024 return, you would have to actually go back and amend 2022, start there, then amend 23, and then either amend or claim the deduction on an originally filed return for 2024. And of course, there's a deadline with going back and amending. The election must be made by July 4th, 2026. So I think to kind of pull this all together here, there's a lot of planning opportunities going forward. And it's important to note that it may not be obvious just to, all right, let's go back and amend. We really have to look at every situation, the whole landscape from 2022 through 2026, and determine what makes the most sense. Where are you going to get the most tax savings? Are you reducing tax that's taxed at the highest bracket, or are you reducing tax that's in a 20% tax bracket? So that's something you just want to consider, and that's what we will consider with you. It's another planning opportunity to help reduce your tax liability.
All right. Well, thanks, Jake, for covering that. A lot of information there on 174. I think the bill had, I think, roughly a year for regulations to come out to basically, 1 year from date of signing of the bill. So from July 4th, we did see some communication from the AICPA recently that there may be guidance as early as this August for related to the retroactive election. There's a lot of taxpayers who haven't quite filed their 2024 return and may want to deduct those 174 expenses on that return. Are kind of in limbo right now, waiting to see if there will be guidance. So we'll have to see where that goes in the next month. So with that, we're going to move on to the 163J interest expense limitation. And similar to the way Jake outlined 174, we're just because there's been changes that, applied to either 2018 or, 2022 in the case of 174. And now we're, dealing with another change, just walking through that history so we understand exactly how we got to where we are and what that means. So the Tax Cuts and Jobs Act was passed in late December of 2017 with provisions that were, applicable heading into 18 and later years. And prior to the Tax Cuts and Jobs Act, there was the only limitation under, we'll call it old 163J. It applied primarily to corporations with foreign affiliates. So, there was really no limitation on deducting domestic interest expense if it wasn't paid to a foreign affiliate, basically. Then we have the Tax Cuts and Jobs Act. We're going to refer to that as new 163J that was enacted in December of 17. And that created a limitation based on 30% of adjusted taxable income. And then we had two periods, over the last several tax years where adjusted taxable income was calculated two different ways. For tax year 2018 to 2021, adjusted taxable income was defined similar to EBITDA. So interest before earnings, earnings before interest, tax, depreciation, and amortization. But then beginning in 2022, adjusted taxable income was calculated based on earnings before interest and taxes. So depreciation and amortization were no longer added back, which most of the time that results in a stricter limit. So you have more interest expense that's subject to that limitation because you're starting with a lower adjusted taxable income number. So the One Big Beautiful Bill Act then modified 163J for tax years beginning after December 31st, 2024. So it applies to the 2025 tax year. And adjusted taxable income is defined similar to EBITDA. So similar to those years from 2018 to 2021. So it's basically making that income number higher in most cases to be able to utilize more and deduct more interest expense. So to kind of walk through an example here of what that means, on the left-hand side of the slide, you have taxable income, and this is 2022 to 2024, where it's based on EBIT and not EBITDA, as far as adjusted taxable income. So you have taxable income before the interest limit of $700,000. In that taxable income, we have $50,000 of interest income, which you would subtract out, and then you would add back your interest expense of $400,000 to get to adjusted taxable income of $1,050,000. If we apply the 30% interest limitation to that adjusted taxable income, that's $315,000, and we had interest expense of $400,000. So that would require us to add back $85,000 to our taxable income after taking into account that interest limitation. So again, it's similar to what Jake did with 174. We're just using a corporate tax rate for a simple approach of 21%. For a total tax of $164,850. If I look at the impact of the OBBBA, again, starting with the same taxable income, we have the same two add backs, interest income, coming out of that, interest expense being added back, but then we also get to add back our depreciation and amortization. So in that top number, we're saying 300,000 has been deducted out of there to arrive at that 700,000. So we're adding that back. So that results in an adjusted taxable income of 1,350,000. So if you look at that compared to the first example, $1,050,000, we're basically 300,000 higher on our adjusted taxable income. So if we take 30% of that again, as we did in the first example, interest limitation becomes 405,000. So that 405,000 is larger than our interest expense in the current year, so we can deduct all of our interests. So the result is basically no change to our taxable income. And our tax, again, using the C Corp rate, 21% is 147,000. So if you look at the difference there, it's almost 18,000 in tax, that is less tax due to the changes under the OBBBA. And one thought there is that while the limited interest more under the TCJA without the current changes, may have been just a timing difference that would have been able to utilize in the future. And that's true, but you would have to have again adjusted taxable income that's high enough to absorb that interest at 30% of it. So while it may have been a timing difference, it's not for sure that you'll be able to utilize that in the near future. And it's just better to have the cash flow in your business to run your business rather than having it put out in cash sooner than it needs to be. So with that, we'll move on to bonus depreciation, which has gone through several changes throughout the years. And we're going to, kind of cover pre-Tax Cuts and Jobs Act, and then get post-Tax Cuts and Jobs Act, and then the impact currently. But, bonus depreciation, pre-Tax Cuts and Jobs Act applied to, equipment, computer software, certain improvements to non-residential real property. And that was at 50% for equipment placed in service in 17. It was going to go down to 40% in 18 and then 30% in 2019. But then the Tax Cuts and Jobs Act was passed, and it temporarily allowed 100% expensing for business property acquired and placed in service after September 27th, 2017, before January 1st, 2023. And then that 100% allowance generally decreased by 20% per year in taxable years beginning after 2022, and expires January 1st, 2027. So we were going to see that, basically completely go away, with the 2025 tax year being 40%, 2026 tax year 20%, and then no bonus allowed in 2027. So under the OBBBA, there is a 100% bonus depreciation permanently restored for property acquired and placed in service after January 19th, 2025. So it's usually a little bit unusual to have kind of a mid-month, mid-year date like that, but kind of similar to the previous slide where the Tax Cuts and Jobs Act, that right side where it says after September 7th, 2017, even though that in that act it was passed in December of that year, so that was kind of retroactive by a few months. And in the current act, it's retroactive from July 4th, kind of back to January 19th of 2025. There's also a new elective 100% depreciation allowance for qualified production property. And then that's for construction beginning after January 19th, 2025. And that includes the manufacturing of tangible personal property, agricultural production, chemical production, or refining. And that's something I'm going to spend a little bit of time on that because it's pretty unusual for bonus to apply to real property. And what we've seen so far, that this is an area that we're watching for additional guidance on, because just because of how unusual it is compared to prior tax law and just the history of things. But what we've read so far, it wouldn't qualified production property does not include any portion of the building property that is used for offices, administrative services, lodging, parking, sales activities, research activities, software engineering activities, or other functions unrelated to qualified production activities. So what that would do is allow, producers, refiners, or manufacturers to fully expense buildings rather than depreciate them over 39 or 15 years, which is a significant benefit. And kind of watching the definition of what production means will be important. But, it generally requires a substantial transformation of the property comprising the product. So taxpayers that with buildings that house both qualified production activities and other administrative office or research functions, they'll need to perform an analysis to allocate costs between functions to get there. A couple of other business changes. The Section 179 deduction increased to 2.5 million with a phase out threshold of 4 million for assets placed in service after 2024. The deduction was previously capped at 1.22 million, and the phase out threshold of 3,050,000. So a decent increase to both of those. Also, the filing threshold for Form 1099 NEC and 1099 miscellaneous increased from 600 to 2,000, although that doesn't apply until 2026. So for the 2025 tax year, that $600 cap still applies. So for the tips credit, which that previously applied only to the food and beverage industry, which provides a credit for the FICA paid by the employer on tips. So it was encouraging employers in those industries to have their service industry employees report more of their tips, and also for the employers to report, as far as those received on credit cards and things, and so they receive a credit for it. And for whatever reason, that only applied to food and beverage on the original, but the OBBBA expanded to include the beauty service industry starting in 2025. Another area that was impacted is the qualified small business stock exclusion. And so, pre-OBBBA, an active domestic C corporation, a really important fact here that the gross assets not exceeding 50 million in value immediately after stock issuance. So when the stock was originally issued, what was the value at that point in time? And if the total value of all stock outstanding is greater than 50 million, it wouldn't qualify. But you could exclude up to 100% for qualified stock held for greater than 5 years. And there were some different periods as far as when the original stock was issued, whether or not 100% applied, but that was the maximum. And then you had an exclusion limited to the greater of $10 million or 10 times your basis, meaning the original cost you paid for the stock. So post the OBBBA, an active domestic C corporation with gross assets exceeding 75 million. So that cap went from 50 million to 75 million. And then you have you still have the 100% capital gain exclusion for held longer than 5 years, but then they added, a couple more tiers in there. So you would still get to exclude 50% of the gain after 3 years, 75% after 4 years. And that exclusion cap went from $10 million to $15 million with the 10 times basis still applying. A couple of foreign changes that occurred. We have I've talked a lot, and Jake also talked about some of these changes all tying back to the Tax Cuts and Jobs Act. The global intangible low taxed income is one of those. Which a couple of things I thought were just a little bit silly in the bill is that they decided to rename a few of these things while not significantly modifying really what they were accomplishing, other than changing some rates that apply. So GILTI, previous abbreviation, is now renamed to net CFC tested income, abbreviated as NCTI, and that there's a rate change there, reduced from 40% to 40% from 50%. And then we also have foreign derived intangible income, which was also renamed to foreign derived deduction eligible income. So we started off with the FDII, added a couple, changes a letter and added another letter for FDDEI. So kind of a not real important change, but the name is different going forward. But there was a rate change there also where it was reduced to 33.34% from 37.5%. Also, the base erosion anti-abuse tax, referred to as the BEAT tax, the bill repeals the scheduled rise to 12.5% and instead sets that rate to 10.5%. But it did retain the existing credit offset mechanisms that reduce the BEAT base. Also, Section 899, which in several versions of the original drafts, prior to this one passed by both the House and Senate and signed into law by the president. There was some language in there around Section 899, and that's really around Pillar 2 and the implementation of that kind of worldwide. But there are agreements with G7 countries to exempt the U.S. from Pillar 2. So that was removed from the final language of the bill. There's a lot in the bill on energy credits. And I'm not going to cover today, we're just due to time constraints, all the details on all of them. I'm going to mention a few. There's several different termination dates. Also, there's some placed in service dates that apply or beginning of construction, different that apply to, a lot of these different credits. And they're kind of staggered. So we have several related to clean vehicles, whether it's commercial or previously owned, that they're terminated after September 30th, 2025. So it's kind of a short window to take advantage of those. Also terminated after December 31st, 2025. A lot of the energy efficient and residential clean energy credit, sustainable aviation fuel credit, those will no longer apply after the end of this year. Also, terminated after June 30th of 2026, you've got the energy efficient home credit, alternative vehicle refueling credit, energy efficient commercial building deduction, and the clean fuel production credit. Additionally, the clean electricity production credit, clean hydrogen production credit, and the advanced manufacturing production credit. One I want to cover just a little bit, the clean electricity investment tax credit. That's the investment tax credit that applies to solar and other energy production projects or as far as like the purchase and the installation of those. So, manufacturing, maybe even construction, if they have, some things they build in-house have use a lot of electricity or other energy. We have bonus depreciation that came back to 100%. And you when you install a solar array, you can get up to a 30% tax credit on the cost of that installation. And typically when you get a tax credit, you have to reduce the cost as far as what you capitalize and depreciate of the equipment equal to the credit. But for this credit, it's basically half of the 30%. It's only 15%. So if if an installation costs $100,000, and you would get a credit of $30,000, and then you reduce your basis by $15,000. You could deduct the remaining $85,000 in the first year using bonus depreciation, and that really helps to offset the cost of the project, kind of going forward to where you get recovery sooner based on your electricity savings over time. A couple other changes, related to meals. There was a 100% deduction allowed for fishing boats and certain processing facilities. So when we look at kind of how this thing came through and a lot of the negotiations that go on, Alaska Senator Murkowski is the one that kind of threw that in there, as their fishing is prominent up in that area. And so, 100% is now allowed, only specific to those activities. Also, so it's 50% otherwise on meals, but the employee retention credit, there's a prevention of payment for certain claims. So there's a disallowance of refunds claimed after 1/31/2024. And also the statute of limitations was extended to 6 years from the date of filing the original return. So, and that applied to quarters Q3 and Q4 of 2021, as far as refunds claimed after that 1/31/2024 date. So next, we're going to cover the 199 Cap A, the qualified business income deduction, which would have expired after 2025. And what the qualified business income deduction, we refer to it as QBI, allows a 20% deduction of qualified business income. That reduces basically your taxable income on a 1040 for those owners of pass-through entities. There's a phase out for specified service trader businesses. There's also limits based on taxable income, wages paid, and an adjusted basis in assets. So it's basically, in UBIA is basically the cost paid for assets that are not yet fully depreciated under their standard lives. So post OBBBA, that made that deduction permanent, and also increased the married filing joint phase out for SSTVs, and also provides a $400 minimum for taxpayers with a 1,000 of QBI. And so that starts 1/1/2026. So related to pass-throughs, the 461L excess business loss limitation that extends current law. So excess losses continue to be carried forward as an NOL to the subsequent year. Opportunity zones, that was made a permanent program on a rolling 10-year basis, and that expanded the program, and reporting requirements begin July 4th, 2025, and then there's a 2027 10-year rolling start. Also related to disguised sales, which, we have one partner that makes a contribution and another partner receives a related distribution. Historically, sometimes treated as a taxable sale of partnership interest, but there was kind of uncertainty. But there's basically the changes in the OBBBA solidify that treatment where that may apply. So with that, I'm going to transition over to Kristen, where she's going to cover some of the individual highlights.
Thanks, Adam. I know everybody's been anxious to see how these things will flow through on your 1040 tax returns. So we see a permanent extension of the lower income tax rate scheduled for individuals, and it indexes it for inflation as well. So effective for tax years beginning after 2025. Well, here's our 2025 tax rates. The 10% bracket goes up to 11,925 for single filers and 23,850 for married filers. And then you'll see it cap out at 37% for those making over 626,000 individually or 751,000 married. And those will continue to index for inflation. Adam. We also see the higher standard deduction that was established under the Tax Cuts and Jobs Act is here to stay and will also be increased with inflation. Single filers have that $15,000 deduction, married filing jointly have $30,000, and head of household have $22,500. This changed back with the Tax Cuts and Jobs Act, and as a result of this increase, we see quite a few less individuals itemizing their deductions. So we're going to walk down memory lane a little bit on the SALT deduction. That would be state and local taxes. These historically have been an itemized deduction, and prior to the Tax Cuts and Jobs Act, there was no cap on how much state and local tax we could deduct. The SALT deduction included state and local income tax or sales tax, as well as property taxes. This deduction really benefited taxpayers in those high tax states like New York, New Jersey, and California. Those who itemized get the benefit, and it really significantly reduced taxable income for those high earners. After the Tax Cuts and Job Act, that deduction was capped at $10,000. Those same types of taxes were taken into account, the state and local income tax and the property tax, but now that is limited to $10,000 in total as a deduction. This really hurt those taxpayers in high tax states and those big earners. The $10,000 limit still requires that we itemize, but again, we're really seeing quite a lot less taxpayers itemizing as a result of this cap. So the changes under the One Big Beautiful Bill Act, that SALT deduction cap was raised to $40,000 starting in 2025. However, that is going to be phased out with income. So for taxpayers making between $500,000 and $600,000, you'll lose the benefit of that additional $30,000 deduction. And for taxpayers more than $600,000, you'll be back at that $10,000 cap. Again, we'll see those taxpayers in middle income households and high tax states benefit most from this, but there will be a lot of limitations as well. The increased SALT cap reduces the need for the PTE tax workaround in many cases. A lot of you might be familiar with those PTE tax returns that we've been filing at the state level, so we can deduct business taxes on the business tax return and pass through that credit to the individual. For taxpayers who are not limited by income limitations and can fully deduct that $40,000, we might want to, play around with not doing the PTE tax return if we don't have to. But there's obviously many opportunities to coordinate those payments and the timing of income recognition with where the SALT deduction limits hit. A few changes to our itemized deductions starting in 2026. The unreimbursed educator expenses now change from being an unreimbursed employee expense to now being an itemized deduction. Unreimbursed employee expenses were set to expire, so moving it keeps that deduction available to educators. There's going to start to be a phase out beginning in 2026 on itemized deductions for taxpayers exceeding certain income thresholds. We may see a limitation up to being able to deduct 35 cents on the dollar of all of our itemized deductions. So again, that's a big planning opportunity, and in big income years, we may want to play around with when are we making our charitable contributions in order to make sure we're getting the full benefit of those deductions. One more thing in regards to charitable contributions is now there's going to be a $2,000 married filing joint deduction for taxpayers that even take the standard deduction. That's on cash contributions starting in 2026. We've got some new credits this year. Well, the child tax credit has been in existence and was set to go back down to 1,000 instead of 2,000 at the end of the year. But the OBBBA has increased that permanently to be 2,200 starting January 1st, 2025. So parents with kids under 17 will get to take advantage of that on this next year's tax return. These Trump accounts are going to be new this year. So for kids born between 2025 and 2028, they're going to get a $1,000 deposit into this tax advantaged account that kind of serves as an IRA type account where you can make contributions and you're able to take those contributions out when the beneficiary turns 18. And then it can be taken out sooner, but with the 10% early withdrawal penalty up until their 15 and a half birthday. So it really functions as a retirement account. 529 distributions have been expanded to allow several new items such as tutoring, homeschool expenses, different kind of credit programs for those who aren't planning to attend college. So it really expands the flexibility on those accounts. There's a few new temporary deductions. The tip income deduction, individuals may now deduct up to $25,000 in qualified tip income to $25,000 cap, regardless of your filing status. And it must be for occupations deemed by the IRS to be customarily receiving tips. They have yet to define that, but I don't think we'll be able to get too creative there. There's now also an overtime pay deduction, which allows individuals with qualified pay to deduct the premium, that extra half-time portion of the pay, up to $12,500 per individual. And that phase out begins with modified adjusted gross income over 150,000 for single filers or 300,000 for joints.
I think one of the important thing to point out there is that there's really not currently a reporting mechanism on the W-2 to separate out that halftime portion for the premium and the overtime pay deduction. So, you know, if you have tipped employees that are going to qualify for this, they're going to want, you know, they're going to need that information. Of course, you know, there may be inside the pay stub a way to look at that or view it. But, you know, they're probably, you know, payroll companies are going to have to get on figuring out how to report that, you know, especially for 2025, as guidance probably won't likely come out from the Treasury on how to report that probably prior to year end.
Excellent point, Adam. Yeah, this will definitely be new and employees are going to have questions. The deduction ultimately is taken on their personal 1040 return. So aside from reporting on the W-2, there's really not a lot else for employers to do. But yeah, we'll stay tuned for more guidance there. Another new deduction is our car loan interest deduction. This allows taxpayers, even those who do not itemize, a deduction of up to $10,000 of interest on passenger vehicle loans that originate between 2025 and 2028. The vehicle must be new, assembled in the United States, and only for personal use. That phase out begins at $100,000 single filers, $200,000 for a joint. Additionally, there's a senior deduction where individuals over 65 can get an additional deduction of $6,000 per individual. And again, there are phase out limitations on that additional deduction. And lastly, we've got our estate and gift tax exemption. As you all probably know, the estate exemption was set to revert back to 14 million at the end of 2025. But the One Big Beautiful Bill has extended the 30 million exemption indefinitely, and it will continue to index for inflation. There's also a $19,000 gift threshold that will also be indexed for inflation. And with that, we're going to send it over to Anita for the Q&A.
Thanks, Kristen. So with the time that we have left, we're going to try to address as many questions as we possibly can. We've had some questions come in. Just want to remind everyone to please use the Q&A feature to submit questions that you may have. So we'll be keeping an eye on that. No particular order, just kind of working through questions as they've been chiming in. Adam, you had touched on the qualified small business stock, or also better known as 1202 stock. A question related to that. Can the qualified small business stock changes be applied retroactively to years prior to 2025, or does it only apply in years 2025 going forward?
Yeah, I think that the old, as far as holding period, being 100% after 5 years, but not, that tiered structure. I think that applies to any stock issued before July 4th, 2025. But as far as to receive the 100% exemption and then also the asset increase to 75 million as far as the value, and then also on the original issuance, and the tiered approach as far as 50% at 3 years, 75% at 4 years. I believe that's on stock issued after July 4th, 2025. So to answer the question, I don't believe it's retroactive to any stock that was issued before that, the date of enactment. But again, something there that when guidance is issued, when the Treasury regulations come out, that may define that differently. But as far as what is currently available, I don't believe it can be retroactively applied.
Thanks, Adam. And then, we address a lot of 1202 questions for our clients. And I think one of the things that tends to get glossed over is the limitations upon which industries and professions may not be eligible for 1202. Just for the benefit of our clients and whoever's on the webinar today, did you see any changes in the bill related to that in terms of eligibility for 1202?
I didn't see any changes related to eligibility. I think it typically, it goes back to the original issuance and that asset value. So as far as eligibility, yeah, you have that increase from 50 million to 75 million. But as far as what's otherwise defined under 1202, I haven't seen any, additional changes as far as eligibility.
Excellent. Thank you. And then we have a question. This is probably towards you, Kristen. Where do you create the Trump accounts? Is it at any financial institution, or are there any parameters around that?
As far as I'm aware, they're still working out the kinks with that. I believe that contributions can begin to be made starting July 4th of 2026. So they've allowed themselves some time to work that out, and we'll circulate that information as we get it.
Perfect. And then probably still to you, Kristen. When does the change in taxing overtime become effective? Is it the 2025 tax year or some other date?
It is the 2025 tax year. So it's likely that we'll be wanting to report overtime box 14 of the W-2s, but starting to track that information and make sure it's available for W-2 time is going to be really important.
Okay, thank you. And then the next question probably goes to Jake, related to 174 and R&D. Does a new law offer taxpayers the option to elect capitalization of 174 costs by project?
Great question. So our interpretation is that it would be an all or nothing approach. So you either would capitalize all of the projects in that given year, or you just wouldn't capitalize at all. I mean, we're still waiting on the guidance to be released, but that's our best assumption at this point.
I think that, following that thought process, it, generally, like if you think about other areas where you can capitalize or elect to fully expense, like bonus depreciation, if you elect out a bonus depreciation for a certain asset class. So when I say asset class, 5-year property, 7-year property, 15-year property, if you elect out for those classes, it's all property that falls under that class. All 174 expenses are capitalized and amortized at 5 years as far as domestic. So I wouldn't think you'd be able to do an election, asset by asset, because they all fall under the same class, basically.
You all three mentioned in various parts of the presentation that we're waiting on clarification, needing clarification from IRS. From y'all's perspectives, based on your areas of specialty, I think there was one piece that we were maybe expecting could be coming out in August, but have either of you heard any timeline from IRS or Treasury related to any additional guidance that may be coming down?
Seen any other, potential release dates other than that the bill states pretty broadly throughout that the Treasury has 1 year from the date of enactment to issue any additional guidance. which gives us some hope because specifically related to 174, that was passed back in December of 2017, and we didn't get any guidance on it until midway through the year after the tax year, the end of the tax year after, it first applied. And so we were working on extensions and trying to file returns where we didn't have guidance on exactly what was required to be capitalized under 174. So it's good we at least have a year to where we're not waiting longer, but I've not seen any additional information.
That sounds good. I appreciate that. Well, trying to keep an eye on time and realizing we want everyone to be able to get back to their scheduled day. That is all the time we have today for questions. I really want to thank Adam, Jake, Kristen for being on our webinar today. I really appreciate you sharing your insights. More importantly, I want to thank everyone for tuning into the webinar. Hopefully everyone is walking away the hour later, getting a better oversight and understanding of what all was part of the One Big Beautiful Bill Act. So I want to thank everyone for joining. And with that, I'll hand it over to Bruce to close us out.
All right. Thank you, everybody. Adam, if you don't mind going to the last slide, just so people can see contact information should you have questions. The QR code's easy to scan. I think everybody's familiar with those at this point. But scan and that'll take you directly to someone's contact information. So please utilize that if you need to. But you will all receive a thank you email for attending. And yes, of course, thank you for doing that. It'll be a link to the recording to this in case you want to refresh something that was said or discussed. And if I think we got to all the questions. So if there's anything that you would like us to follow up with you on directly, just please reach out to us. You can always go to our website and just use the contact us feature, and that'll get to marketing, and we'll get it forwarded to the right person. So again, thank you for attending, and this concludes our webinar.